Consolidation can be tricky because it's not just adding numbers together. We have to cancel out internal stuff so we don't double count. Do you want to walk through this entire solution step by step from the top? Or is there a specific working or account that's tripping you up right now? Perfect. Let's start with the foundation. We need to know who owns what and for how long. Looking at your materials, Pegasus owns 100% of Sylvester. This is a full acquisition. Uh, Check this out. The pre-acquisition retained earnings are 1,200,000. That's what Sylvester had in the bank before Pegasus bought them. Now, why do you think we need to separate what Sylvester earned before the purchase versus what they earned after Pegasus took over? No worries. This is the core logic of consolidation. Think of it like this. If you buy a wallet for 20 bucks and there's $5 already inside it, you didn't earn that $5. You just bought it. So the 1,200,000 that was already there when Pegasus bought Sylvester is treated as part of what they paid for, not profit for the group. Next, we do the cancellation. We have to get rid of the investment in Sylvester line on the parent's books. Check the table. Pegasus paid 1,300,000. On the other side, Sylvester's worth at that time was its share capital of 100, plus those had paid 1,500 for that same $1,300 value. What do you think we would call that extra 200 they paid? Ah, I see the confusion. Let's look exactly at where these numbers are coming from in your materials, so we're on the same page. The 1,300 for the investment is right there in the first table of Activity 3, under Pegasus's non-current assets. And the 1,200 for the pre-acquisition earnings, that's tucked away in the notes of Working 1 in your answer key. It tells us what Sylvester's earnings were on the day they were bought. Wait, did it look like I wrote different numbers before? My bad if that was unclear. Does seeing them in the table help trace where they came from? Aha! I see exactly where the confusion is. That's a great catch. You're looking at the FIDI 200 in the main table, right? So, check this out. The 5,200 is what Sylvester has today, 3 years after being bought. But the 1,200 is what they had on the first day Pegasus bought them. In consolidation, we have to split that total into two parts. The part Pegasus bought, the 1,200, and the part Sylvester earned since they were bought. If they started with 1,200 and they have 5,200 now, how much profit do you think they made while Pegasus was the boss? Spot on. That 4,000 is the magic number. This 4,000 represents the growth. Since Pegasus owns 100% of Sylvester, the group gets to claim all of it. Now we combine that growth with Pegasus's own earnings to find the total for the whole group. Look at the parents' earnings in the original table, 26,800. We add that 4,000 profit from Sylvester, and boom, we get 30,800. Does it make sense why we only add the 4,000 and not the full 5,200 from Sylvester's books? Boom. You've got the hardest part down. That logic is the soul of consolidation. Now for the easy part, the line-by-line addition. We just add Pegasus and Sylvester together for most items, but we leave out the internal stuff we canceled. Look at the share capital. See how I only used the 5,000 for Pegasus? A common mistake students make is adding the subsidiary's share capital too. But remember step 2? We canceled Sylvester's 100,000 share capital against the investment. So the group's total shares are always just the parent shares. Does that cancellation logic from earlier start to click now when you see the final result? All right, let's keep it moving. Since we've walked through the whole process, here's a quick summary and some flashcards to lock in that knowledge. Check out the board. I've summarized the big 3 rules we used today. Before we wrap this session up, how are you feeling about that calculation for the group retained earnings now? Does it feel... Wait, you're totally right. I showed the table, but I didn't actually walk you through the math for those individual assets. Let's fix that right now. For the property, plant, and equipment, we just grab that 24,000 from Pegasus and add Sylvester's 4,200. Same thing for the current assets. 8,500 plus 2,100 gives us 10,600. Notice what's missing? That $1,300 investment line from Pegasus's books is gone. If we kept the investment and added Sylvester's assets, we'd be double counting the same value. Does that line-by-line addition for the PPE and current assets make sense now? Bingo! You hit the nail on the head. Exactly. Since Pegasus and Sylvester are now viewed as one single family or group, that investment is just an internal link. It's like moving $10 from your left pocket to your right pocket. The group didn't get any richer, so we cancel that internal transaction out to show only what the group owns in the outside world. Now that we've cleared up the assets and why that investment disappears, do you feel ready to move on to a different problem? Or is there any other part of this balance sheet that looks a bit fuzzy? All right, RMJ, let's reset and go through this exactly as it appears in your images, piece by piece, so you know where every single digit comes from. Look at the first table in your first screenshot. Pegasus has 24,000 in PPE and Sylvester has 4,200. We just add them. The blue 24,000 is from the Pegasus column. The red 4,200 is from the Sylvester column. Same for current assets, 8,500 plus 2,100. Now, let's look at the equity section, which is where most people get stuck. In the equity section of the second table, Pegasus shows 5,000. We only use the parent share capital. Sylvester's 100 is canceled out. This is the big one. Your second image shows working 3. It takes Pegasus's earnings of 26,000. From the main table. Then it adds the growth of Sylvester. How did they get that 4,000 growth? The 5,200 is in the Sylvester column of the main table. The 1,200 comes from the working one note in your second image. It's what Sylvester had when Pegasus first bought them. Finally, we add the liabilities. 2,000 plus 1,000. When you add it all up, 5,000 share capital plus 30,800 earnings plus 3,000 liabilities, you get 38,800. It matches the assets perfectly. Does seeing every number linked back to either the main table or the working notes clear up where that 30,800 came from? Boom! That's what I like to hear. You've officially mastered the core of consolidation. Everything on the board now is a direct map of how to solve these problems. It's all about that parent plus subgrowth logic for the earnings. Since you've got this one down cold, do you want to try a quick what-if scenario to see if you can spot a trick, or are you good for today? All right, let's talk strategy. If you see a consolidation problem on an exam, use this 4-step trick to make sure you never miss a number or double count an account. The biggest trap, they said, is giving you that 1200 pre-acquisition number in a tiny footnote where you might miss it. Always remember, only add what was earned during the group's lifetime. So, imagine if in a new problem, the sub had 6,000 in earnings today, but had 1,500 when they were bought. How much growth would you add to the parent's earnings? Boom. You've got it. 6,000 minus 1,500 is 4,500. You're officially a consolidation pro. That's the session, RMJ. You crushed those calculations. Feel free to grab a screenshot of the board if you want to keep that strategy list for your homework. Is there anything else on this homework or any other financial accounting topic you want to tackle while we're on a roll? You bet there is. If you love formulas, these three will get you through almost any basic consolidation problem. This is the one we used for the 30,800. Remember, post-acquisition profit is just RE today minus RE at acquisition. And for the assets and liabilities, it's the line-by-line formula. Does that last one is for the cancellation work? In your activity 3, that formula equaled 0, which is why goodwill didn't show up on the final balance sheet. Do those equations make it easier to visualize what we're doing with the numbers from the